makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Nvidia becomes the world's most valuable company as tech drives another record-breaking session on Wall Street, while Fed officials again urge patience on rate cuts. UK inflation falls back to the Bank of England's 2% target for the first time in almost 3 years, but services prices remain sticky. Plus, we'll bring you an exclusive interview with Britain's second richest man. Jim Ratcliffe says the UK's had enough of the governing Conservatives and signals his approval of Labour leader Keir Starmer. Now, we also have some other big interviews in the next hour. We'll be joined exclusively by the former U.S. House Speaker Paul Ryan and by the Vanguard chief economist Joseph Davies. We'll also speak to the Citroen chief executive Thierry Koskas. So, frankly, it's all happening today. A look at the markets. Of course, a lot of U.S. trading is closed. European stocks, for the moment, actually posting some pretty small moves. Again, traders, I think, are probably seeking some fresh catalysts in the wake of the latest tech-driven rally in the U.S. In terms of cross-border, or certainly cross-border, a lot of the talk about regulation, Basel, is maybe weighing on some of the banks, especially the ones over in Switzerland. And then mixed economic data showed U.S. industrial production increased, helped by a broad-based pickup in factory output. We also had retail sales that barely rose, and prior months were revised lower. We had Fed officials reiterating the need for more evidence of cooling inflation before lowering rates, and that's again permeating through all of the markets, both in Europe but also in the U.S. NASDAQ, look, a lot of the cash equities are not opening today because of Juneteenth, but NASDAQ futures, 20,237. Pound, we're keeping an eye because of this CPI data. And then France. Everything's been happening in France. Not only are officials not happy with the deficit, but, of course, the election there is extremely uncertain. What a week to be in Europe. Let's talk exclusively to Joe Davies, Vanguard's chief economist and global head of investment strategy. Thank you, Joe, for joining us. A very quiet week.
Yes, very quiet.
It's extremely quiet. Nothing's happening in the markets. It's not like anything's happening in Europe. I mean, what's going on? It feels like everything, some of the stress points are all coming at once.
Well, sure. I mean, I think we have markets trying to grapple between economic change, of course. You know, we have growing momentum from a really low level in both the UK and Europe, and now we have election uncertainty. So I think those two confluence of events, I think, explain some of the market action we've seen.
So what does it mean on, what's the next catalyst actually for support on the markets?
Well, I think at the end of the day, I mean, politics are always important, but it's going to be the economic fundamentals. I mean, the investment markets ultimately will view that, and history shows that. So I think from the economy perspective, there's some good news. I mean, inflation, this has been a long time coming for inflation to come down. So there's still little embers here and there in the service sector, but when you zoom out, it's clearly a positive. And it's, again, our theme was it was going to take interest rates higher for longer, for some time, to see this contour of events. But we're finally seeing it.
But, Joe, if you look at, I mean, the Fed is kind of pushing back against the market narrative, right?
Yes.
I mean, how long do they have to push? I feel like they've been pushing back against the current for the last 12 months in one way or another.
Well, yes. And in fact, I would say for nearly the rest of the year, I mean, our theme has been that the Federal Reserve in particular was going to have to keep rates higher for longer. This is a 2-year theme for us, and yet the markets could handle it. And so I think that's what we're continuing to see. So inflation has to come down. The labor market is balancing better. Yeah. And it was that second component that I think, gave us that insight. So I think ultimately, and I will applaud the Federal Reserve because they were under some pressure here, right? There was concerns of recession, inflation still very high, but they've navigated this event. Now, we've had some good string of events, positive news on immigration that I think came at the exact right time.
Nvidia, I mean, that's a story and a half.
Sure.
Now the most valuable company in the world. Does AI kind of change how you look at economics and therefore investment?
Sure. Well, again, we've looked at, we've done research to say how transformative could AI be? And I think it has the prospect to be more transformative than the personal computer. That does not mean, however, and that's for the next several years, that does not mean, however, that markets are not overvalued. I think the U.S. equity market, it's an uneven story. I mean, you have the technology sector that continues to run away, yet that sort of, I would label it euphoria, is not broad-based. And so it can break one or two ways. I think we can see some modest deceleration in the tech sector. At some point, that has to come. But if the economy holds up, I think the other parts of the market could catch up. And I think that would be good news for the market.
But, Joe, do you think we're in a bubble then?
I would be reluctant to say that. I mean, valuations in parts of the market are at near historic highs. So history would say that we have prospects for lower returns in those segments of the market. But as I said before, Francine, it's not broad-based. You have small caps, not nearly as euphoric in that sense as part of the large cap names that you've said. It's not on value-based companies. And so, again, I think it's an uneven picture, but I'm concerned of the momentum going solely into technology.
So what does that, again, what does that shake out? And are there adjacent, I guess, industries that could also, have a correction on the back of that?
Well, history shows that two things will ultimately happen. It's just unknown what the timing is. That with transformation, the very sector that benefits from the transformation still can become overvalued, even though if it changes the economy. And so I think that's what we will see with the technology companies. They're already discounting phenomenal growth. And also what history shows is that gap between, say, technology companies and the rest of the market, that will narrow in the coming years. But that's an annual 3 or 5 year outlook, not a 6-month play.
So, Joe, what's the right way of looking at a portfolio building? Again, there's not that many catalysts, I guess, for equities that are actually priced to perfection.
Yes.
And yet the rally kind of continues.
Well, I think you have to look outside of where the greatest momentum is. And now it takes a longer multi-year horizon, but ultimately you're rewarded. I think you're being rewarded less for the technology sector, despite its transformative ability. So that would say, outside of the U.S., and if you're in the U.S., don't forget other parts of the market that may not have as much of the headlines, but have a greater cushion for future returns.
So where? Because Europe is having wobbles.
Yeah. Well, I would actually say, it can get uncomfortable. But history shows you have to go where the discomfort is to benefit from what, finance people call risk premiums. So you go to actually parts of Europe, you go areas that have slower growth. Yeah. And for the U.S., I'm not picking on technology, but it's actually outside of technology that you don't want to make sure that you're underweight too much. Because that introduces risk to the portfolio.
But, Joe, we've seen it in Europe, some of the luxury industry really slow down. That's partly because of China. That's partly because of a saturation. You see, the dynamics in France definitely putting a dampening mood on Europe as a whole. Is that a buying opportunity?
Yes, if the price paid for growth is at the right level. And so even though the markets are discounting, more somber or, lower growth in Europe and parts of the emerging market, you always look at that multiple relative to the expected growth. I mean, over long periods of time, technology companies tend to underperform other parts of the market, which is generally not known. It's because of the price paid for growth. And so I would at least have an eye on that on a multi-year horizon.
Okay. So interesting, Joe. Thank you so much. Joe Davies, Vanguard's chief economist and global head of investment strategy, stays with us. We'll dig a lot deeper into maybe some of the Asian markets as well. This is Bloomberg. Welcome back, everyone. Now let's continue our conversation with Joe Davies, Vanguard's chief economist and global head of investment strategy. We were talking, Joe, first of all, thank you so much for sticking around. We're talking about some of the supports and some of the catalysts maybe for these markets. Sure. I mean, what's your take on France? It's been really kind of blowing up in terms of markets in the last couple of weeks after that surprise election for Parliament.
Well, you actually said it, right? A surprise, right? From my perspective, I'm trying to then diagnose what are the economic implications. Uncertain in the near term. Right, uncertain in the near term. It's going to clearly introduce uncertainty. There's going to be the year of election, right? Because it's not just France. But then we have to think about what are the potential market implications, which we can get to. Yeah. So what are the market implications? I mean, we've seen a widening of the spread, for example, between France and Germany. Yeah. Is it a buying opportunity? There can be. Again, I think it's important to say, listen, politics are really important, but then let's look at the pairing with the economic fundamentals. And all else equal, I would say, there are opportunities in the fixed income market if those spreads would continue to widen, right? And then also the fascinating look that we've looked at is market history. How politics are extremely important, but I was shocked to find in the United States and the UK over the past 50 years plus, the returns of the equity market, fixed income market are the same in election and non-election years. So again, politics are important, but other things can matter. It feels like France is a market event.
and it's unclear, what happens. And as you say, it's unclear what kind of economy we're left with.
Yeah.
So what do you do with French assets right now?
Well, again, I think you have to look at the economic fundamentals. I mean, the deficit rules are going to be important. What is that long-term trajectory of debt, right? And then what other structural? I always, as an economist, I'm trying to look at is there changes in structural reforms. And what I mean by that, labor policy, innovation policy, trade policy, retirement, because they're going to have a longer bearing beyond the business cycle.
Your take on the UK? It seems, fairly quiet, certainly compared to France.
I picked the right week to be in London. But again, uncertainty and tension, right? Again, I'm looking from my perspective, Francine, right? Okay, economic fundamentals, policy, there's some change, there's some differences in policy stance. And so it's going to be based upon how the election unfolds. What will that potentially do to the economic trajectory of the next 2 years? It's unlikely to have a bearing in the next 6 months.
But Joe, there's an understanding that actually all G7 countries are so have such a big burden on debt.
Yes.
There's not much fiscal space actually for whoever gets into power. So again, what does that mean for some of your appetite for assets?
Well, I think again it's around the sustainability, and so again, I'm coming from the United States where we have a similar trajectory issue, and so I think it's not just the level of debt today, it's what the anticipated future path is, and so that's where we tend to focus on for an investment strategy, because that gets to your point, a really good one around fiscal space and bond spreads.
Do you worry about some kind of credit event in the U.S. happening, a bond auction going really badly, or something that could actually be the catalyst of something bigger?
I worry about it over the next 10 years. It's not the near term, and I'm not complacent on debt. I mean, the U.S. has more fiscal space given the depth of the financial markets, but it doesn't mean that deficits don't matter. And so we're starting to see a structural component of deficits. So I think in the next 5 years for the United States, it's actually a horse race, a tug of war between AI and how transformative it could be, and some of the modest but growing headwinds we see from sustained deficits.
I mean, you also have a big election in the U.S. Does that change
perhaps
significantly the trajectory in terms of trade, in terms of, I guess, economic prowess?
It may not as much as some may think, because what we could see is just a step back, or again this trend towards deglobalization, not a complete retreat. I mean, that's extremely unlikely, just given the nature of supply chains. But tensions between the U.S. and China, and I think we see that from both political parties, and so I think that's a secular theme, not just what's going to come out of this election.
Have you had to be more of a political analyst? Again, if you look at economic blocks, I guess the retracing of alliances also changes who you trade with.
Yes, certainly. I mean, geopolitical risk is the toughest thing to handicap. It's another reminder of the importance of diversification from an investment perspective. But yes, I mean, economics, politics, they've always been joined to some extent. But the markets, I think, over the next, certainly for this year, seems like it's had more primacy than what it has been, say, 10 years ago.
Okay, will you give me your best bet? What's the one thing that you think it will do well for the markets right now?
Inflation continuing to come down, and the central banks having the continued resolve to make sure those last little embers go out, because that carries the day for economic prosperity.
Joe, so great to have you here in the studio with us in London.
Thank you so much
for joining us. Joe Davies, Vanguard's chief economist and global head of investment strategy. Now, coming up, worries for European car manufacturers amid the EU's tariff war on Chinese EV imports. We'll speak to the chief executive officer of Citroen. That's next, and this is Bloomberg. Well, European car manufacturers have expressed concerns about the market for electric vehicles as China and the EU embark on a tariff war. Well, joining us now is Thierry Koskas. He's the chief executive of Citroen, part of Stellantis. He also joins us as the company unveils its new C3 Aircross. Thank you so much, Mr. Koskas. I think the car is behind you, and it looks pretty stunning, but in demand in Europe for cars in general has been softer because of a number of things, cost of living, interest rates going up. Do you see that continuing? What do you see in store for the coming months?
Well, I think that the market remains fairly strong. It's progressing year on year. So we are very confident that the market conditions will be favorable in the months to come. It's very much a question of being able to offer the cars that the customer needs, particularly electric vehicles. You know that we are selling more and more electric cars. We need to be able to offer affordable electric cars, and that's what we are doing with the new C3 Aircross.
So talk to me a little bit about, in general, the slowdown has been more pronounced for EV cars. And again, this varies from country to country. This may be because some of the incentives have been removed. How do you see demand for EVs in general? And also, how do you see demand for the new C3?
Well, actually, yes, I understand that there is a slowdown in some countries, but we shall not forget that anyway, we have to grow the share of electric sales. Just to give you a very concrete example, in 2025, we will have, like any other manufacturer, to double the share of electric cars in our sales. This is the short-term objectives that we have to face. So at the end of the day, we have to sell electric cars, and we have to sell electric cars profitably, which means we need to be able to offer products that the customers want. And when we look at the new EC3 we revealed a few months ago, first European electric car below 25,000 euros. Now today, the new EC3 Aircross, electric SUV below 30,000 euros. We are coming with very attractive offers, and we think that it will enable to grow the electric car sales for Citroen.
But do you worry about pricing? Are you very sensitive to that, especially depending on the kind of market or the country you're in?
Well, obviously, pricing for electric cars, it's a big challenge. So we have to overcome that with, first of all, very competitive offers. That's what we have today. Today, you do not find an electric SUV below 30,000 euros. We are introducing that in the market. But also, what I would like to highlight is it's not only a question of price, okay? It's going down, it's great, but it's also a question of usage cost. If you use, for example, a C3 Aircross electric compared to a petrol version, you will probably save up to 1,000 euros per year. So it's absolutely significant, which means, yes, the selling price may be higher. You can finance the car, obviously. But then in terms of usage cost, the customers will enjoy a much more favorable usage cost. That's very important to take into account.
Yeah, but if it's not translating into consumer demand, then it's quite tricky. I mean, the other big thing is, the incoming additional EU tariffs on Chinese EV imports. Are you expecting that to give a big boost to the EV market in Europe?
Well, obviously, the Chinese offensive is there. The Chinese competitors are coming, and they are challenging us because they are coming with very competitive offers. So what we need to do is to fight with the same weapons and to be able to produce cars at a competitive cost versus the Chinese. This is what we are doing with C3 and C3 Aircross. We think we have very competitive cost base for a car made in Europe that will enable us to face the Chinese competition and participate to the growth of the electric market in Europe.
Mr. Koskas, can I also ask you about the big recall of Citroen and DS cars? I mean, I know that you're coming under fire in France and elsewhere for maybe not having been as transparent and as quick to actually recall some of the Takata airbags and some of the other vehicles. Can you update us on what's being done now and why maybe you have critics saying that you were a little bit late to the game?
Of course. So we have recalled 500,000 cars. What is specific with this recall is that we have asked the customers to stop driving their car. The priority is really the safety of our customers. So you can imagine that it's a huge operation. It's a big number of cars, particularly when we ask the customers to stop driving their cars. So we are moving at a high speed. We have replaced already 70,000 airbags. And we are putting at the disposition of the customers, at the end of the month, there will be, in Europe, 60,000 cars to ensure the mobility of the customers. We know it's painful for some customers, but at the end of the day, safety matters, and this is the only priority that we have. So we are improving the situation every day, but we understand it's complicated for some customers, but it's improving every day.
Thank you so much for joining us. That was, of course, the Citroen Chief Executive Officer, Thierry Koskas, joining us live in Paris. Now, meanwhile, Ferrari's first electric car is going to cost at least 500,000 euros. That's according to a report by Reuters. The luxury automaker is preparing to open a new factory in northern Italy, which could boost group production by up to a third. Well, Bloomberg also understands that a second EV model is also under development, though the process is at an early stage. Coming up, our exclusive interview with Britain's second richest man, Jim Ratcliffe. He tells me the UK is ready for a change of government and why he thinks the European chemicals industry is a mess. That's next, and this is Bloomberg. Nvidia becomes the world's most valuable company as tech drives another record-breaking session on Wall Street, while Fed officials again urge patience on rate cuts. UK inflation falls back to the Bank of England's 2% target for the first time in almost 3 years. Services prices remain sticky. Plus, in a moment, we'll bring you my exclusive interview with the British billionaire and chemicals tycoon, Jim Ratcliffe. Now, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. The UK's second richest person says Britain has, quote, had enough of the governing Conservatives after 14 years in office. In an exclusive interview ahead of the next month's general election, Jim Ratcliffe also spoke about the scrapping of preferential tax treatment for residents whose permanent home is outside the UK.
I wasn't a fan of the non-dom change. I thought that was very foolish, I have to say. But that wasn't Labour, that was Conservative that came up with that smart idea. 60,000. I mean, you've got 60,000 very wealthy people in London. Why do you want to encourage them to leave? That doesn't make any sense to me, really. Because they all bring, enormous value to that economy in the south. I mean, most of the non-doms are in London, in the south of England. But I think that regeneration of southern Manchester would attract quite a lot of investment.
What's your take on the UK right now, ahead of the elections, on the UK? Is it good for business? I mean, you're here, you're here in London.
I think that, the Conservatives now have had, a fairly long stint, and they've put forward a whole series of prime ministers that haven't been terribly successful, really, to be honest, the last 4 or so. So, I think the UK, everybody in the UK now, you can see that the mood in the UK, everybody's ready for a change. They've had enough. So it's, I think I've met Keir Starmer a couple of times. I like Keir. I think he'll do a very sensible job.
You've been disappointed with the way Brexit has been run? Is that a fair qualification?
Yeah, it is actually. I agree. Yeah.
So how would you do it differently, and how do you think Labour will deal with it? Would you be? Would you ever go into politics?
No, I don't think they'd have me, actually. I'm probably not, I'm not PC enough, I don't think, for politics. And I'm certainly not very woke. But no, I mean...
How would you run the country?
I think... how would you run the country? I think... For me, you've got immigration, which is one issue, and the other issue is the economic issue. If you just look at the economic issue for the UK, it's really, in my view, it's quite simple. Is the UK economy is £2 trillion. The GDP is £2 trillion, and the government take half of it, at least half of it. So the government spend is £1 trillion. Right? So, in my view, they're major. And if you look at Ineos, we spend 60 or 70 billion a year, something like that. The government spends 1 trillion. That's an awful lot more than us. So you need to spend the money well, because you're not spending your own money, you're spending the population of the UK's money. And, you know, there are good reasons why people pay taxes. You've got, you know, healthcare, you've got police, you've got roads, all those types of things. And I don't think the government manages those things very well. And I don't think it focuses on them very well. And I don't think it's got the right quality people running them. But they're spending £1 trillion. You know, the health service is a mess. We don't have security anymore. Education's a bit of a mess. You know, we can't run sewage systems in the UK. I mean, you know, we had sewage systems running in the Victorian era. And, you know, we allow all the utilities. I mean, just take that as a simple example. We allow all the water utilities to be sold off. They were mainly bought by French companies. Then the French companies pay £50 billion in dividends, but don't reinvest in the equipment to ensure that we've got top-class equipment to manage our, you know, sewage and drinking water facilities. And then all of a sudden it's a crisis. I mean, why doesn't the government say, if you want to buy a water utility, then these are the minimum requirements you need to, you know, and if the people don't behave, then do what they do in America, they lock them up. You know, there's some consequence if you misbehave.
Jim Ratcliffe also spoke about how he made his fortune in chemicals and why the high cost of energy and carbon has left the European industry struggling to compete with the rest of the world.
There's not much chemical industry left in the UK. No, it's finished. Chemical industry in the UK is pretty much finished, really, unfortunately. I don't think the government ever really recognised the importance of that. It's an enormous industry worldwide. But I mean, if you look at petrochemicals in Europe, it's about the same size as automotive. It's a really big industry, and similarly in America. I mean, in Europe, I think trillion euro industry, chemicals and petrochemicals. Right. It's about the same size as the car industry, but there's very little left in the UK now. It's all. I mean, if you look at the UK, if you go back 25 years, 30 years ago, manufacturing in the UK was about the same level as Germany, about 25% of GDP. Germany's still 22 or 23% because it's got a government which has been focused on maintaining a healthy manufacturing base in Germany. But in the UK now, we're maybe 8% of GDP from 25% 30 years ago. So manufacturing is one of the reasons you had these powerhouse of the North, you know, and those types of initiatives, because the North is a manufacturing base, but it's pretty much all gone, and I think it's probably too late now. Could
Labour not bring it back? How do you think a Labour government would change?
Again, it's not a switch, really. You have to have a long term.
Do you think they have a plan?
I don't know. Not that I'm aware of for bringing back. I mean, you know, places like America are in a great place for manufacturing because, you know, they've got cheap energy, they've got no carbon taxes, they've got a government which is very interested in it, they've got social costs which are very manageable. But then you look at Europe. I mean, Europe's a mess for petrochemicals today. Everybody's leaving petrochemicals in Europe, which is I've never seen in my working life before. But if you look at, I mean, I'm talking mainland Europe, but I mean, sort of, it applies to the UK as well, really, is energy costs 5 times America. Gas is 5 times the cost of America. Electricity is 5 times the price of America. I mean, it's not 5% or 10% or 50% more, it's 500% more. So anything where, any sort of activity which involves using energy in some form or another is disadvantaged in Europe compared to America or the Middle East, obviously.
Jim Ratcliffe there, the billionaire chairman of chemicals giant Ineos. Now, he's also a shareholder in Manchester United, and we'll have more from our interview on the subject of football in tomorrow's show. Coming up, we'll speak with the former U.S. House Speaker Paul Ryan on U.S. politics, trade tensions, and the impact on business. The exclusive conversation is up next, and this is Bloomberg. Trade tensions with China, economic growth, and a potential return of Donald Trump as president. Just some of the issues weighing heavily on the U.S. ahead of the election in November. Now, former House Speaker Paul Ryan has seen the highs and lows of Washington in recent years. He attracted criticism recently when he said Trump is unfit for office. Well, Paul Ryan joins us exclusively here in the studio. Thank you for joining us. It's been a while, and there's a lot to talk about. It feels like geopolitics and politics domestically and abroad are all over the place.
Good morning, Francine. Nice to see you as well. Yeah, I think they are all over the place. I'm here in London as vice-chairman of Teneo, a CEO advisory firm. And we're basically advising our clients who see a lot of unpredictability on the horizon, and they're trying to scenario plan for which way various governments are going to go. It's a little easier to predict here, I think, than it is in my country, which is a razor-thin polling and election. And it's just hard to determine who's going to win the election. Therefore, you have to scenario plan on two different potential administrations. So can you talk us about those scenarios? I mean, is it impossible to know who will win come November now? Yeah, I think it's just too close to call. If you really want to look at it, if this thing is tied in polling going into the election, which is probably the likeliest of scenarios, because right now Trump is polling at peak, Biden is polling below his peak performance. Let's just assume Democrats come home at the end of the day, as they typically do. It's probably going to be a few 100,000 voters in about 5 or 6 states that will determine the outcome of this election. My state of Wisconsin is one of those. Trump won it by 25,000 votes out of 1.61 million cast in 2016. And then he lost it to Biden by 20,000 votes. It's just that close. And this is what campaigning, what makes a difference? Is it, the candidates showing up, or is it big policies on the turnout, economy? Campaigning, candidates showing up, the ground game, as we describe it, and getting your turnout organization going. But really, at the end of the day, it comes down to the new swing voter in America, which is a suburban, college-educated swing voter. And let's go back to Wisconsin, for example. Out of 1.61 million cast, 53,000 Wisconsinites, that's what we call ourselves, in the suburban part of Wisconsin, didn't vote for Trump, but voted for every other Republican on the ballot. And then 20,000 of those 53,000 voted for Biden, giving him the 20,000 margin of victory that he got. It's just that close. There's probably going to be Arizona, Nevada, Wisconsin, Michigan, Georgia, Pennsylvania. So too close to call. What happens if Donald Trump is in the White House? Right. So the economy. On tax policy, personally, I think it will be much better, and a lot of executives see it that way, because you have to remember that our tax law that we wrote in 2017, the individual side of that tax code has many expiring provisions, some of which hit small and medium-sized businesses, and then we have some corporate provisions like research and development tax credit, expensing provisions. Those are all up for grabs. The next presidency will help determine what happens there. So, Trump's going to be more pro-business on taxes. Biden is proposing to get rid of those things. And then it comes to tariffs. Trump's proposing a lot of tariff increases. Biden hasn't reduced the Trump tariffs. He's continued those tariffs. But I don't think he's proposing a whole new range of tariffs with respect to everything but China. On China, you basically have a bipartisan consensus. So you've called Donald Trump unfit for office. Are you surprised at the amount of money of Wall Street titans behind Trump? No, because I think it's too close to call, and I think people are basically trying to hedge their bets and decide. They don't know who's going to win the White House. So I think they want to basically make sure that they understand which direction the country's going to go and which administration, which they do not know will take place. That's what we basically help our clients at Teneo do, which is, what's trade going to look like under this administration? What are regulations going to look like? What's mergers and acquisitions and antitrust going to look like, et cetera, et cetera, et cetera. And right now, it's just too tight to see, so you have to plan for both contingencies. Okay, how often do you get asked about budgets and the debt ceiling? Yeah, that's my hobby horse. That's my biggest. That's what I used to do in Congress. Fiscal policy is my thing. I'm very concerned about this. One of the reasons why I'm frustrated, like many Americans, about our choices for president is neither is proposing to do anything about a coming debt crisis in our country. Our debt is already as large as our economy. It's going to go nowhere but twice as big as that. And so we have an entitlement problem, which is these entitlement programs are going bankrupt by the end of the decade. And so no one's proposing to solve that. We have to get ahead of that. Otherwise, we're going to have a debt crisis in America. And it's not inconceivable to have a Treasury auction failure in a short period of time. So what's a short period of time? Like in the next 6 months, 12 months? No, is it a big credit event? It would probably be after we're done cutting interest rates. So if you're going into an interest rate cutting environment, you're going to be able to sell your bonds. Jay Powell just said he's going to do only one rate cut this year. Let's just assume it's in December. And then a number of rate cuts if all things work according to plan in 2025. So the question is, let's just assume, say, 2026, it's really hard to put a finger on these things. Do we have clarity in our fiscal policy? Have we done what we need to do to get our balance sheet in a good place? And right now, both of our candidates for president aren't proposing to do a single thing about it. I think the only shot we have, given that political reality, is perhaps an entitlement commission, but one with teeth that requires Congress to vote on it. I served on Bowles-Simpson the last time we had one of these things, and it could be ignored by the president and Congress, and it was. So you have to have an entitlement commission that says Congress is going to have to vote on this, up or down, no filibuster, no amendments. Yeah. And then hopefully you have a president that's willing to accept its results, if provided they're substantial. And that's, in my opinion, the best way we get out of, short of Congress actually doing its job in fixing this problem, it's the way we get out of the ditch.
What are the chances of Congress actually taking a more, I guess, fiscally responsibly approach and trying to fix it?
Well, you have to remember we have to have economic growth. And if you have a massive tax increase on businesses and individuals, you can really harm growth. My guess is we're going to have divided government of some form. Okay. It's pretty clear to me that we're going to win the U.S. Senate because of the way the Senate map is laid out. So let's just assume, for the sake of argument, we have a divided government. I think that's the likeliest assumption. And then you're going to have a negotiation on tax policy in the next session of Congress. And what that looks like is basically what we try to help scenario plan. But that's definitely going to happen. One thing people don't in the continent understand as much is most of our businesses are not taxed as corporations. They're taxed as individuals. Right. And that provision that lowers their tax rates so that their tax rates are commensurate with corporations, the larger companies, goes away. So you could have a tax rate on small businesses, medium-sized businesses, as high as 46% in this, 44.6% in America. And that would be a massive tax increase on businesses. I don't think anybody wants to see that happen, but there's not clarity as to whether or not they're going to fix this or not.
Paul, when you go around and speak to chief executives, what is the one thing that they actually underestimate? I don't know whether it's geopolitics. We have Putin also meeting with, North Korea's Kim Jong-un. Is that going to change trade relations across the world? And is that what we're underestimating?
I think uncertainty is the number one problem. So there's so much uncertainty. There's geopolitics. There's NATO. There's Ukraine. There's Putin. There's conflict with China. You have a war in the Middle East. And then also, by the way, you have a bunch of tariffs that are being proposed. So you just don't know what's going to happen. We don't know what antitrust laws are going to look like. If Biden gets a second term, is he going to double down on a lot of regulations? So you just don't know, not to mention all the geopolitical risks that are outside of any government's control. So that's what CEOs are trying to prepare for.
And what do you tell them? Just be nimble and prepared for
here's what door one looks like. Here's what door two looks like. You want a contingency plan for both scenarios.
Yeah, but how impossible is it to say actually what door one looks like, given the unpredictability of Donald Trump in the past?
Without getting into all the details, I think on tax and regulatory policy, it's pretty predictable. On tariffs, just listen to what he's proposing. I think it's just that clear. And then you have to plan accordingly. On regulations with Biden, I don't think you should expect him to do anything different than what he's doing now, which is a lot of regulations. I think if Trump gets in, you'll have less regulations. So you have to go through all those kinds of scenarios.
What's your Republican Party going to look like? I mean, you were once one of the great hopefuls. Do you see still a place for you in it?
Well, I am still a Republican, of course. I consider myself an anti-establishment Republican. Trump has taken over the Republican Party. It's really a populism without any anchor to principles. I'm a big believer that you want your party pledging fidelity to a set of principles and policies that solve problems versus a person. And I don't think a personality-type politics is durable. So I do think at the end of the day, our party, like we have in the past, will have a big discussion about what we stand for. What are our ideas? What are our principles? And who are the best people capable of carrying those ideas forward? That's not the conversation we're having right now.
Right.
But he's going to, if Trump wins, he's a one-term president. He cannot have a second term because he already had one. So I just don't think it's durable, and I think we're going to have a real calling as to what we stand for.
And if he doesn't win, is that when you have that conversation?
Yeah, that happens sooner rather than later.
And who do you think? I mean, where do you see?
Well, that's a good question. We have a great bench of talent. We have a lot of really good, effective governors. We've got a bunch of new people that have come to Congress. So I'm not worried about our depth of our talent pool. It's just the shadow that Trump casts over our party is dominant. And when that shadow goes, whether it's in 1 or 4 years, then you're going to have a more lively discussion about what is the conservative movement in America, what does the Republican Party stand for.
So crypto, you're also a believer, kind of a proponent of crypto. Where do you see it?
Well,
in the
I think
central
blockchain
bank
has a lot of
currency?
use cases.
Right. For central banks?
Yeah, so, well, what I proposed the other day is that we should advance stablecoin legislation because stablecoins actually creates a lot of new demand for U.S. debt. So we talked just a minute earlier about potential Treasury auction failures. Well, it would be nice if we created more demand for our debt, and if we had a law, which there's bipartisan support for in Congress, to advance stablecoins. I think that helps put the dollar in the digital world. Right. It helps give people who have bad currencies in some countries digital dollars, and it creates new demand for our debt. So I think there are a lot of good, interesting, exciting use cases for blockchain, for Web3. Stablecoins is one of them, and I think it actually helps solve some of our fiscal problems as well.
Does that happen under Trump or Biden?
Yeah, I think it happens under either because it has bipartisan support. It's really a matter of if, not when.
Okay, thank you so much for joining us. A real pleasure to speak to you again. The former U.S. House Speaker Paul Ryan joining us this morning. Now, coming up, award-winning architect Francis Kéré, our latest guest on Leaders with Lacqua Goes Green. We discuss his incredible journey out of poverty and how he's inspiring the next generation. We'll bring you a taste of that interview next, and this is Bloomberg. Internationally acclaimed architect Francis Kéré became the first African winner of the prestigious Pritzker Architecture Prize in 2022, the highest honor in the profession. But he started off with a very simple dream, to build a school in his village in Burkina Faso. Well, I spoke to Kéré about his remarkable journey and why sustainable architecture can be both beautiful and affordable.
When I started to build, I never knew, encountered this word sustainability. But I knew from my heart, from deep on me, if I take the most available material that people knows and I improve it a way that it can inspire my people, but have a long-lasting life, this is good. If I can get people to be part of it and learn new things, sharing knowledge, I knew this is important because we're not called, Francine, we're not called to stay forever here on the planet. But if you teach people to do things properly, rather than to teach them to make very fast business, always business, fast. So, if we teach them properly, if we go, they will go, keep doing like what we have done.
And you can see that full interview on Leaders with Lacqua Goes Green, airing at 9:30 p.m. New York time tonight in the U.S. and at 6:30 p.m. London time on Thursday. Now, it is a bit of a quieter day than usual because of Juneteenth in the U.S., so there's a lot of cash trading that will be closed. For the moment, European stocks posted small moves. Again, traders seeking fresh catalysts in the wake of the latest tech-driven rally in the U.S. You can see NASDAQ 100 futures gaining on the back also of Nvidia becoming the world's most valuable company to extend this year's record-breaking surge. And then traders also yesterday pushing the S&P 500 benchmark closer to the 5,500 mark. Now, we'll be back, of course, with Bloomberg Markets. We look at France, also political upheaval there, 3.186 for that bond, and then sterling on the back of UK CPI, a little bit lower than expected, sterling 127.33. More with Bloomberg Markets. This is Bloomberg.